Hello YouTube, my name is David Mitchell and welcome to my channel, and if you're a subscriber, welcome back. Today I'm going to be discussing two titans when it comes to the investment principles, DCA, dollar cost averaging, and lump sum investing. And I'm going to compare the two and the benefits and which one I believe is the most effective approach, especially when it comes to long-term investing. Now, the textbook definition of dollar cost averaging is pretty much you're investing a specific amount in a specific area consistently over a period of time. And the complete opposite of that is lump sum investing. So it's pretty much just pumping all of your money, all of your available cash at one time into a specific area. If you've watched a number of my videos, you'll know that I'm always talking about not messing up your dollar cost averaging, not chasing hype, and being careful as far as to invest consistently over the long term, and you'll come out better as far as for chasing a trending stock and throwing 20 grand in there and say, oh, I'm going to double in the next 48 hours because of the pump and dumps. Now, with dollar cost averaging, the main benefit that you're going to have there is control as far as the amount of money that you want to put in, because in the short term, the market is controlled by emotions. And in the long term, the actual company's principles, finances, the integrity of the leadership, that's going to have a greater impact over the long term. But in the short term, you're going to be dealing with a lot of the emotions and the up and downs. The dollar cost averaging is allowing you to capitalize off of those dips. While lump sum investing, if you go all in at a particular price and the stock dips down to $8, you're either going to have to come up with new cash and get your dollar cost average down, or you're going to have to ride that out and wait until pretty much over the long term anyway to realize those profits that you have. The biggest advocate against dollar cost averaging is, what if there's a rally after you put your initial $500 in for that month and you say, I'm going to invest $500 every month for the next 10 years. And what if there's a huge rally and you could have had more money if you had just gone all in? Now, I'm not against putting a large sum of money up front, but most people participate in dollar cost averaging whether they know it or not. The consistent investing in, whether it be mutual funds, the S&P 500, or a particular stock, if you're doing that consistently over a period of time, you're investing somewhat as far as aligning with the dollar cost average approach. Now, the biggest benefit of that is going to be, yes, you may miss out if it was a huge rally. If you put $500 in and there was a huge rally next week and it doubled in price, you'd still realize those gains, just not as much as far as if you didn't go all in. But history has shown over the course of the long term, your returns will be more consistent, predictable, and you'll have a greater chance as far as seeing a profit if you do so over the long term versus trying to time the market. Another thing I always say on here, time in the market always beats timing the market, because if you balance that out and if you are just picking particular stocks specifically, there's a greater chance that you're going to lose money. And even if you do double in one stock, that's usually not going to outweigh all the areas that you've actually lost money in. Another component as far as the dollar cost averaging is, history has shown that good companies, solid companies, companies that are building on, in particular like the ones on the S&P 500, history has shown that typically over time, these companies will realize more profits and increase their value. So as far as losing money, you're more so going to see that on your riskier stocks anyway. And this is going to happen if you're trying to trade a trending stock or a new IPO is opening up and you're saying, hey, I'm going to jump in and try and double up. That's going to increase as far as your risk. Now, if you're looking to have like a long-term portfolio or even just grow something consistently, the DCA approach is going to be your best bet. If you don't remember anything else from this video, you make money when you buy, not when you sell. And that goes the same for real estate as well. The profits that you're able to realize is going to be determined at the price at which you bought it for. So always keep that in mind as far as you're investing, even if it's short term or long term. You can speculate, but you can also have a more predictable return as well. And I'm not saying that lump sum investing doesn't have its benefits or even its place. You can absolutely make money by doing lump sum investing. In the case of the example I used earlier, if you went all in a particular stock and then it doubled in the next week, it will take you years to realize that by dollar cost averaging. Dollar cost averaging is just simply a safer approach and a more consistent approach, affordable approach, even for most people if you don't have $10,000, $20,000, or more than that to just dump in a particular stock at one time. It's going to be the best choice as far as for most people. But as far as making money quickly, absolutely, you can do these things with lump sum investing. I believe we saw a lot of that this year. I covered a number of those companies in earlier videos. But the problem with that is you develop those bad habits and say, hey, I can always, double up, and there's always that chance. And consistently, eventually that's going to catch up with you if you're consistently doing that. So my recommendation, as far as why I'm always preaching, do the DCA approach, is because you're going to have less likelihood of losing your money, and the cost of entry is also lower as well. And even if you do take a loss, or if it is a dip down, that's not the end of the world. It's actually an opportunity for you to buy more at a better price versus, okay, I'm all in, now this has to go up or otherwise I'm screwed. Thank you for watching. I had to cover DCA because I believe that's probably one of the most important topics that I can cover on this channel, and go over the benefits with you. So if you found value in this video, please consider subscribing, liking for the YouTube algorithm. It really helps the channel get exposure and more people see this video, because I believe everybody needs to see this video, especially the people that are newer to stock investing. Dollar cost averaging is one of the most important principles that you can go by, especially if you're just getting your foot into the market. So please consider subscribing if you're not already, giving the video a like. I thank you and I appreciate all of you, and until next time.